You're working harder than ever, but rent's higher, food costs more, and somehow your paycheck buys less every month. Meanwhile, they tell you the economy is fine. While Wall Street celebrates record profits, over 60% of Americans live paycheck to paycheck. That's not an economy, it's a slow-motion crash. And these aren't isolated cases. This is Main Street. These are your neighbors. Behind the scenes, corporations are buying your future, your rent, your job, your kids' options, one quiet transaction at a time. But this didn't happen overnight. Three forces have been quietly eating away at the backbone of America's middle class, bringing it to its knees in 2025. And honestly, the first and most devastating sign is the rise in bankruptcies. September 15, 2008, 17 years before America plunged into the worst financial crisis since the Great Depression. The collapse of Lehman Brothers was a seismic event in financial history, unprecedented in scale. Yet the big banks received hundreds of billions in bailouts. Washington also launched aggressive stimulus measures, pumping trillions into the markets and economy. These interventions not only ended the recession, but also fueled record-breaking bank profits and ignited an historic stock market boom. But did any of these bailouts fall into the pockets of lower or middle-income Americans? Of course not. More than 8 million Americans lost their jobs, pushing the unemployment rate up to 10%. Housing prices also plummeted by a third from their 2006 peak and fell even further in California, resulting in as many as 10 million people losing their homes. Think that's scary? Well, the financial crisis was so nasty that it stalled U.S. economic growth so much that, according to recent calculations by the Federal Reserve Bank of San Francisco, every man, woman, and child in the country lost an average of $70,000 in income over the next decade. So where are we going with this? Well, U.S. corporate bankruptcies have surged to their highest levels since the aftermath of the global financial crisis, as persistent high interest rates and weakened consumer demand place severe pressure on struggling businesses. Almost 700 companies filed for bankruptcy in 2024, an 8% increase from the previous year and the highest number since 2010. The primary catalyst for this wave of bankruptcies was the Federal Reserve's decision to raise interest rates in an effort to combat inflation. Higher borrowing costs made it increasingly difficult for companies, particularly those with substantial debt loads, to service their obligations. And concurrently, inflation eroded consumer purchasing power, which led to reduced spending on non-essential goods and services. The core industries affected by this trend were retail, dining, and healthcare, as consumers became more discerning in their spending habits. But you're probably wondering, how does this persistent trend of corporate bankruptcies affect the American middle class? Well, the answer lies in the interconnectedness of the economy. When companies hit financial trouble, they often slash costs, cutting jobs and trimming employee benefits. This leads to layoffs and wage stagnation, putting more pressure on middle-class families who often rely on steady growth in their earnings to keep up with rising costs such as housing, education, and healthcare. On top of that, communities always suffer from reduced economic activity when businesses close or move away, so you can say goodbye to large investments in local infrastructure. And that's exactly why the middle class always picks the short straw. Middle-class families often face financial pressures like paying high tuition fees for their kids and covering costly medical expenses for aging parents. And when the family is stretched too thin, all it takes is one setback, such as losing a job, the death of a loved one, reduced overtime income, serious illness, or divorce, to quickly push them from financial stability into needing bankruptcy protection. Making matters worse, many can no longer rely on their home equity as a safety net, since the recent real estate and interest rates crisis encouraged them to refinance and tap into their home's value to cover past expenses. With more of their income going toward housing and rising costs for medical care, education, vehicles, childcare, and other essentials, many are turning to credit just to cover everyday expenses. And this brings us to the second sign of a diminishing middle class: the permanent renter fiasco. Remember the time when Americans fantasized being a smiling couple with 2 kids, a dog, and a house surrounded by a white picket fence and an ample area for gardening? For much of the 20th century, owning a home was considered the cornerstone of the American dream. More than just having a place to live, ownership was about financial security, community belonging, and building a future. It offered the average working American a way to accumulate wealth, pass it down to their children, and participate in an economy that rewarded long-term investment. But today, that dream feels increasingly out of reach for a growing share of Americans. Gone are the days when rent costs weighed bitterly on just lower-income households. Now it's the bane for the middle class as well, as home affordability is at the worst it's been since the 1980s. Nearly 4 in 10 middle-class renter households are burdened by costs, according to recent analysis of Census Bureau data. That's up almost 20% since 2019, while the already high share of cost-burdened low-income households rose just 2%, and it's even more strenuous for those who dream of ownership. So why is this happening? Why are more Americans renting for longer or permanently, and what does that mean for the country's economic future? Well, let's start with the basics. Wages for most Americans have barely budged in real terms for decades, despite the cost of everything going up. In many parts of the country, particularly in urban centers where economic opportunities are concentrated, renters are paying 30, 40, sometimes even 50% of their monthly income just to keep a roof over their heads. When that much of a paycheck goes toward rent, there's little left for savings, retirement, emergencies, or investing in the future. And that means fewer people can afford a down payment, qualify for a mortgage, or even consider buying a home, no matter how hard they work. But there's more to this story than just numbers. Since the 2008 financial crisis, the financialization of housing has strangled the middle class. Wall Street firms and large institutional investors began buying up massive swathes of residential properties, particularly single-family homes. What was once a fragmented market made up of individual homeowners became a playground for corporate landlords who could outbid regular buyers with cash offers and scale their operations with ruthless efficiency. Homes were being bought to generate rent instead of moving in, and in doing so, these firms have helped push prices even higher, reducing the supply of affordable homes, making it harder for everyday people to compete in the market. But perhaps the scariest show of a divide is the fact that according to Federal Reserve data, the typical homeowner in the United States has a net worth that's 40 to 50 times higher than that of the average renter. That gap is particularly staggering because home equity is often the single largest source of wealth for middle-class families. Without it, renters are locked out of one of the most reliable methods of financial growth in American history. They pay into the system month after month, but unlike homeowners, they don't build equity. They just pay someone else's mortgage. And this isn't just an individual problem, it's a generational one. When families can't build wealth, they can't pass it on. That means their children start adult life with fewer resources, fewer safety nets, and less room to take risks. Maybe they delay college, maybe they take on more debt, maybe they never get the financial boost that a previous generation might have used to put a down payment on their first home. Over time, this inequality compounds. The children of renters are more likely to become renters themselves, trapped in a cycle that makes upward mobility increasingly elusive. And so the middle class begins to erode, not in one dramatic moment, but slowly through a million rent checks that don't come back, through the quiet despair of knowing that no matter how hard you work, you're just getting by, through the realization that the American dream for many has moved out of reach and may not be coming back unless something fundamentally changes. The rise of the permanent renter class is not just a symptom of economic inequality, it's a driving force behind it. One of three. The first was the rise in bankruptcy, the second was the permanent renter class, and the final pick is the synergy between quiet quitting and job insecurity. For the uninitiated, quiet quitting refers to a workplace trend where employees do only the bare minimum required to meet their job responsibilities and maintain employment. It's basically an employee who no longer goes above and beyond for their employer, choosing instead to stick strictly to what their role demands. Now, this behavior comes with its fair share of perks, like the tendency to maintain a good work-life balance. However, it's also one of the warning signs of the collapse of the American middle class. People fear being replaced by AI, outsourced labor, or becoming contractors with no benefits. And even if they keep their jobs, the payoff is shrinking. Healthcare is unaffordable, housing costs are out of control, retirement feels out of reach, and wages don't match inflation. We came across an interesting survey that showed only 30% of Americans are highly satisfied with their pay, down from 34% the previous year. Of those who are dissatisfied, 80% say they struggle to keep up with the cost of living, while 70% feel they aren't paid enough for the quality or amount of work they provide. The old idea that hard work leads to a stable life doesn't hold up anymore, so workers check out emotionally, doing only what they must to get by. Companies, on the other hand, see quiet quitting as disloyalty. Rather than fixing the root issues, they respond with more layoffs, stricter policies, or automation, all of which further deepens the disconnect. Make no mistake, guys, what's coming isn't a recession. It's a generational reset, and no one is coming to save you. If you feel this in your bones, you're not alone. Subscribe, comment, share your story. This channel is where we face the truth that they won't show you.